Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill by Mel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, or good evening, wherever you might be joining us in the world today. I'm Bill by Mel. I'm the Debt Doctor. We're here today to talk to you about real estate values, and especially as it pertains to trends in residential and commercial real estate here in the United States as we come into the heart of the summer of 2025. And we're going to go over some data, and we're going to bring you up to speed looking at what's happened in the last 5 years, what changed about 2-3 years ago, and where we now see things going in the near term and in the years ahead. I want to remind you that if you're tuning in here for the first time and you enjoy it, please subscribe and like us. More importantly, whether you're a first timer or this is, again, you're watching us a second time, share us with the world. I have made a promise to you that we are going to bring you the most prescient information as it relates to real estate, financial markets, investing, how a family has to deal with things. And really what the Debt Doctor is about is how do people deal with not only individual debt, but maybe look for opportunities in the purchase of debt, in lending money, in investing in the debt space. I work in this industry. I not only am here to share the education and the conversations and really keep you on the cutting edge of what's going on in the industry, but I think it's very valuable that you are hearing from somebody who works and breathes and lives on the front lines of mortgage, real estate, finance, private equity. I'm involved in all of it. So I want to teach, I want to share this knowledge with you, but it's important to you and it's important to me that I have my foot in the door. I manage funds that invest primarily in residential and commercial non-performing, sub-performing mortgages. And with the dislocation that we have now seen in the values of real estate, the change of interest rates in particular, that not only changed the cost of loans, but also had, maybe not so obviously, a dramatic impact on the value of real estate. And some of that real estate value impact, much of that real estate value impact has yet to be realized. Just like whether anyone always says, don't look at, the value of your home as real money. Many of us have our greatest single investment is the equity in our home. But until you've sold that home, that equity is not real. It's just on paper. And so it's something that many will keep that in mind as well. And we're seeing examples of that play out every day as I go out in the industry and look at performing, sub-performing, non-performing loans. as meet young bankers who are for the first time dealing with cost of capital, who are dealing with sponsors who can't appraise their way out of their situation. And we'll talk about all of that stuff here on the Debt Doctor in future podcasts. We're going to have great guests, and I'm excited about all of it. Well, that being said, I just want to do a quick update this morning. As I said, we're coming into summertime 2025, and we've seen some very interesting factual data come out about the state of the real estate industry. ChatGPT can give you this answer, of course, but it's a lot in how you ask the question. One of the things that we have seen very noticeable, I play in major metros, Florida, the Northeast, Midwest, Chicago. We have properties in 30 states, mortgages in 35 states, performing, non-performing, California. And we have seen for the first time, I'm here to tell you, you may have seen it on other folks starting to speak about this in the public knowledge, is that a majority, now 60% of US counties have now seen a decline year over year in value. You get into certain areas like Austin, for instance, and you'll see an upcoming episode I do with my friend Anthony Fernando. He's based in Dallas and the Austin area. He's worked those markets for years. He's got a real, we speak about the fact that Austin hit a peak in 2022, and on average, real estate values are down 22% in 3 years in Austin. And maybe it doesn't hurt right now because the folks that have seen that decline in value, a lot of those folks that was paper wins to begin with. But as we see the economy tightening up here, as we see volatility increasing, as we see people starting to lose their jobs, because there are layoffs being announced by major corporations, especially in the tech area, we will start to see the impact of folks having to sell this real estate, which is now appears to be down in many major metros around the U.S. I think that what I like to get data from my friend from the Reventure app. If anyone has ever seen Nick Gurley's podcast, shout out to him. He does a lot of great information about, and he's developed some really great data on the industry right now. But it certainly, the data is there. There is the real estate market that just 2 years ago was super on fire, is now cooling off in a tremendous way. If you ask anyone in real estate that's really working real estate on a day-to-day basis, when it comes to areas of the Southeast America, that includes Florida, it's night and day from where it was 2 years ago. We've seen a decline in Florida in the condo markets by as much as 25%, especially in low-rise condos. Some of that impact coming directly from the rise of property assessments related to the new laws that have to reinforce, that require condos to raise capital to insure these older buildings, as well as the rising cost of insurance, if you can even get it. I'll refer to, I was looking at some data and analytics in February from a group out of Washington, MSCI. The major headline from this report just about 2 months ago: after a grueling 2023, the U.S. commercial property market expanded slightly in 2024, We analyze the activity, different buyer groups, etc. While things have been trading, we have seen some major discounts in the commercial real estate market. And again, unless a sponsor is forced to sell or a lender is faced with an offer for a payoff less than the value of their loan, you don't really see the realization of the decline in value that we're talking about that started in 2022, 23. So, just to point to another key factor that has got us concerned, the FHA delinquency rate is now double digit. What are FHA loans? These are high LTV loans insured by the federal government, allow borrowers to put as little as buyers of new first and second homes to put as little as 3% down payment plus their closing costs. It's a way that it is a great program that's been around for almost 100 years, and it allows a large part of the lower middle class to move up. I know my parents bought their first and second home with an FHA loan, and it really allowed us to rise the social ladder. Well, those folks are really getting stuck, because imagine if you bought a home with a 97% loan 2 years ago, and if, as the Reventure app and other data shows, you've got an actual decline. I'm going to show you in value in most areas. And what you're dealing with, if you have an FHA loan that you got 2 years ago, and the value, and you put only 3% down, means you have a 97% loan on that property, and the value of that house is down 10%. Not unreasonable in major metros, especially San Antonio, Austin. These are markets like Texas, even, that nobody expected to have cooled off 5 years ago. Even throughout the Midwest, Cleveland, Indiana's down over a 5 year period, down 60. The growth is down 60%, which is obviously just a slowing. Let's look at the value declines. Still see some value increases in some of those Midwest areas, but down in the Southeast now, and especially in Florida. So coming back to the conversation about value, there is downward pressure in all avenues of the real estate market. We're seeing it in single family rental market. Primarily, when I say single family rental market, I speak about the large private equity firms that bought 30,000 homes, especially a lot of them in the Sun Belt or in areas where they could buy homes inexpensively, the Southwest. And when they bought homes for 200,000 5 years ago, that those rents were more than paying for the value increase in those homes. We're now seeing a decline in those markets. We're seeing those books. I'm telling you, as an insider, I'm seeing those books, those real estate firms starting to try to sell the homes, and they're right now priced 10-15% above where the market is. So there's dislocation there. We're seeing dislocation in apartment. Any multifamily deal that was done 3 or 4 years ago, those were modeled to lower cap expectations that will ever exist again. So if you got a high LTV, even in a 70% or an 80% mortgage, and on something that was valued at a 5 cap, that's now an 8 cap or a 9 cap, you've lost all of that equity. I have private equity investors, partners in our deals that have told me that their equity has been wiped out on what was supposed to be very safe multifamily um, cash flow investments. And of course, in the mortgage market, where that translates is where I want to speak to, and where I think everyone's attention needs to be is on private lending. Private credit is a big industry. We'll talk about various aspects of that throughout our podcast, but private lending in the commercial mortgage space, and when I say commercial mortgages, I'm referring also to business purpose mortgages given on residential real estate, single family. So that's like bridge loans, construction loans, fix and flip loans, debt service coverage ratio loans. The private market came in and expanded so rapidly the last decade that there was a lot of fighting to give money. And in many ways, I will equate the origination of private debt on real estate, whether it's commercial real estate, these multifamily deals I told you that are upside down now, or single family fix and flip given to just a less qualified and broader audience of real estate investor, whatever that might be, we are seeing that deteriorate in a pretty rapid way right now. There has been the cost of that capital has risen so dramatically in the last few years that if guys couldn't get out of deals 2 years ago and they're stuck in 2023 originations, 2024 originations, those loans are going bad today. I'm hearing it even from banks who have loans that are all performing well now, but they're coming up on what's known as maturity. See, in commercial real estate loans, the maturity of those loans, that's meaning the forced refinance or payoff of those loans, is always much shorter than what it is in residential conventional loans. The payoff requirement, the maturity of those loans always will happen anywhere from 1 to 7 years, even if the loan is based on a 30-year payment amortization. There will be a balloon payment required no greater than 7 years. And 7 years is a pretty short period of time. 7 years was just before the COVID, before the pandemic. So it's important to understand that there is this wall of maturities, several $1 trillion in the next 5 years, 4 trillion, in the next year, 1 trillion of commercial real estate loans, and that could be commercial real estate loans on residential properties, investor properties, which we now know private credit has taken the majority of those originations, not the banks, not anybody regulated, non-qualified mortgages. And we've got commercial real estate, which is now just starting to see, and the proof is in the pudding. All you need to do is Google a little bit, and you'll find crazy deals that have gone upside down. Brookfield Asset Management, one of the great investors in the office space, the great in major metros throughout this country, gave back $100 million office buildings in downtown Los Angeles. They just gave them back to the lender. In one case, they worked with the lender and negotiated a short payoff. So not only did Brookfield lose all of its equity in the building, they lost the building, they lost all the cash flow, they sold it to another investor, and the bank that lent them the money had to come to the table and pay the bank off for the shortfall from what the buyer was willing to pay. And it was to the tune of tens of millions of dollars on a trophy office building in downtown LA. The proof is in the pudding. We're now starting to see it happen in residential. We're seeing slowdowns in major markets. We're seeing a rise of listings, and we're still doing very well in certain markets, but those are for me to know, and I'm not going to share those with you because I got to go back to work and go make deals in the secondary market and go make money in this business. So if you like what you hear, don't forget to subscribe and share. And I hope to see you again. Hope today's information was prescient and valuable. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.